Okay.
ठीक है. Cool. So yeah, welcome everyone on today's session. As you know, it's a special session because we're taking a break from our normal readings and taking a sort of a forward view of the upcoming parts of Volume 3 that we'll be reading. Our guest today is Professor Deepankar Basu. He's a professor of economics at the University of Massachusetts Amherst and broadly has three main research areas: classical political economy development in India, and applied econometrics. I think the reason I sort of got to know about him and I read more about him is he's also helped to construct these very long time series on the rate of profit across the world and in different economies, which brings is at least trying to revive a certain amount of empiricism, or at least trying to show a certain amount of empirical validity to a lot of the claims that Marx made. And he also wrote a book called The Logic of Capital, which basically tries to present and elaborate on the argument made by Marx across 3 volumes. As I also mentioned slightly earlier, he has this he teaches a lot of courses. So there's one course called Marxist Economics. It's available on YouTube, and it's another great sort of, it takes you through the Marxist argument in a very systematic manner. Today, we'll be discussing parts 4 to 7 of Marx's volume 3 of Marx's Capital, which is broadly deal with merchant capital, interest-bearing capital, industrial capital, credit, rent, and revenue. With that, over to you, Professor Basu.
Okay, thank you, Rohit. So it's great to know that there are study groups which are still reading Capital. I mean, it's really good. So what I will do is I will give a broad overview and then really open it up for questions and comments, and rather than really just being me talking. So let me start with a quick kind of point about the 3 volumes. So it is important to know that the 3 volumes are organized in a particular way and there is a logic behind it. So the 3 volumes are organized at different levels of abstraction. So volume 1 and 2 is organized at what Marx calls capital in general. So it is kind of abstracting from the fact that capital is fragmented. There are different capitalists who compete amongst themselves. And so the process of competition is abstracted from when we are looking at volume 1 and 2. So in volume 1, Marx is really looking at the question of how surplus value is generated. And in volume 2, how it is realized. So when the commodity is produced, surplus value is generated, it needs to be sold. Only after it is sold will the value and therefore the surplus value get converted into monetary form, which will be ready for the next cycle of capital accumulation. So that is the process of realization of surplus value, which is volume 2. Now, once you have read volume 1 and 2. So once you have read volume 2, you come to volume 3, which is at a lower level of abstraction, in the sense that the process of competition between capital is brought into the analysis. So now we no longer think of capital as a homogeneous block and labor as a homogeneous block, but different capitals competing amongst themselves. And through the process of competition, what happens is the surplus value that was created and realized now gets redistributed and distributed in society. And it emerges as the income stream of different fractions of the non-working class. So that is really the core argument that Marx elaborates in volume 3 of Capital, the distribution of surplus value. Now, the distribution of surplus value also goes through several steps. So the first step of the argument, which you have probably already read, so that's the first 2 parts of volume 3, is how the total surplus value gets distributed between what Marx calls industrial capital. So let me pause. Industrial capital should not be understood as industrial production. Industrial capital in Marx's terminology is capital which is involved in the production of commodities. So in the production of commodities, those capitalists who are involved, the capital that they represent is what Marx calls industrial capital. So it can be production of goods, it can be production of services. So that does not matter from the perspective of political economy. What matters is whether it is produced for the market to be sold for a profit. So that is the broad notion of industrial capital. So the first step of the argument, let me quickly go over it, you have already read it, is different segments or different fractions of industrial capital have different organic composition of capital, meaning some fragments have more constant capital as a proportion of total capital and some have less. Now, if there is this distribution of organic composition across the sectors, then for all sectors to have the same average uniform rate of profit, you need a certain set of prices to emerge, which Marx calls the prices of production. So the first part of the argument is that in the long run, the competitive process gives rise to a set of prices, which is the prices of production. Now, two important implications arise from this. First, the prices of production are necessarily different from the values of the commodities. So the value, meaning the total labor that is necessary to produce that commodity, that has to be necessarily different from prices of production, because some commodities have more variable capital per total unit of capital, so they generate more surplus value. So if value was equal to price, then you could not have the same rate of profit. Since you need the same rate of profit, why? Because if there are different sectors with different rates of profits, then capital will move from sectors which have low rates of profit to those which have high rates of profit. So this movement of capital between sectors in search of higher rates of profit give rise to this kind of abstraction of a long run picture, where once this process has worked itself out, what you will see is a set of prices, which Marx calls the prices of production. And those prices will ensure that capital invested in every sector will get the same rate of profit. So this necessarily means that the value that was created in a sector is different from the value that is realized in this sector through the prices of production. And that means that some surplus value moves from one sector to the other. So that is why this is the first part of Marx's argument about the distribution and redistribution of surplus value. So this is the first part. We have so far abstracted from what Marx calls commercial capital. So now, after Marx works out this argument of the price of production, he goes back and brings commercial capital into the picture. So what is commercial capital? So remember, industrial capital is capital which is involved in the production of commodities, or you can say in the production of value and surplus value. Now, in a capitalist economy, the production of surplus value has to be followed by the realization of surplus value. So realization of surplus value means the pure act of buying and selling. So let's take an example. Let's say there is a capitalist who produces cars. So once the car has been produced in the production process, the car has value and therefore surplus value. Now, the capitalist is not interested in the car. The capitalist is interested in converting the value into monetary form. So to do that, the car has to be sold to a consumer. So the pure act of just selling the car after it has been produced and transported to the location where it will be sold, that last part is the pure act of buying and selling. So in the development of capitalist society, a fragment of capital gets involved in and in specialized, it specializes in organizing the selling of the commodity. So the fragment of capital that is involved in the pure act of buying and selling of commodities is what Marx calls commercial capital. So let's go back to that example. Let's first say that the same capitalist organizes production, transportation, and sale. So in this kind of a vertically integrated firm, the capitalist is doing all the three things. It is producing the commodity, transporting it, and selling it. Now, over time, what happens? There is a division of labor in society, and some capitalists start specializing only in the act of selling. So now what the production capitalist does is produces it and probably transports it and hands it over to the capitalist who specializes in selling. So that last capitalist is a representative of merchant capital. So merchant capital is a fragment of capital which specializes in the act of realization of surplus value. And industrial capital is the fragment of capital which specializes in the production of surplus value. So production, we should understand broadly. It is not only the actual act of production, but also transportation, because many commodities are not consumed where they are produced. So from Marx's perspective, transportation is also a part of the production process, broadly understood. And the final stage is when the commodity is sold off, and that is merchant capital. So now we can see that merchant capital is functional to the overall reproduction of capital, meaning the reproduction of capital means starting with a sum of money, using it to purchase labor power and means of production, bringing them together to produce a commodity, and then selling the output to reconvert it back to monetary form. So this whole chain is the circuit of capital. And if this chain keeps recurring at the aggregate level, then the total social capital gets reproduced. Now you can see that reproduction of total social capital requires that the last stage also be converted, also be completed, that the commodity be sold. So therefore, the part of capital that is specializing in selling commodities, in realizing surplus value, is functional to the overall reproduction of capital, even though it is not involved in directly producing surplus value. What it does, it helps in realizing surplus value. And because it is functional to capital in the sense, a part of the surplus value is appropriated by the capitalist who specializes in pure buying and selling activity. So think of Walmart or Amazon, who do not produce anything. Their profits is really a part of the surplus value, which is handed over by the production capitalist or industrial capitalist, because this Walmart or Amazon helps realize the surplus value and complete the circuit of capital. So from the overall perspective, merchant capital is the part of capital which helps in realizing surplus value. Since it is functional to capital, it is able to appropriate a part of the surplus value. Now, how does this actually happen? So you can think of it as a two-step process. So the industrial capitalist sells the commodity to the merchant capitalist at a price which is below the price of production. And then the merchant capitalist sells the commodity to the consumer at the price of production. So through this two-step process, the price at which the commodity is sold is the price of production, and the profit is partly taken up by the industrial capitalist and partly by the merchant capitalist. So this is broadly the place of commercial capitalists. Now, a little bit of terminology. So Marx when he talks about what I'm calling commercial capital, has a slightly different terminology. So let's be aware of that. Marx talks about trading capital or merchant capital, trading/merchant capital, and then further divides it into money dealing capital and commercial capital. So commercial capital is the part of merchant capital, which is involved in buying and selling the commodity. And money dealing capital is the part which is involved in other activities related to purchase and sale, like bookkeeping, keeping track of the amount of money, doing money changing, etc. Now, this is not a very conceptually important distinction, so I merged the two and call it commercial capital. Essentially, what is important from the broad perspective of reproduction of capital is that this fragment of capital helps in realizing surplus value. Therefore, because it is therefore functional to capital, it is able to appropriate a part of the surplus value. So this really completes the first step of the argument. So due to the difference in organic composition of capital, there is a redistribution of surplus value across industrial capitals. Then you bring in merchant capital, a part of that surplus value gets appropriated by merchant capital because it helps in realizing surplus value. Now, there is a further redistribution of this surplus value to two different fragments of the ruling class or non-working class. One is those capitalists who specialize in lending and borrowing sums of money, which Marx calls money capitalists. And the income that they get from doing this is known as interest. So once again, the logic is the same. If we think of capitalism very abstractly, the capitalist who actually does the production has the sums of money that is needed for the whole thing. But as capitalism becomes more complicated, there is a social division of labor. A fragment of capitalists start specializing in hoarding money and then lending it to production capitalists or merchant capitalists. And when they do that, it benefits the production capitalists because they can make larger investments, they can increase the scale of their operations. And for using the money for a given period of time, they give a payment to the money capitalist. So that money capitalist earns income just by lending the money and getting back the original sum of money, but something in addition. So the original sum of money is the principal and the extra amount is the interest. Now, where does the interest come from? So let's go back and look at the capitalist. Let's say there is again, going with the same example, there is a capitalist who is producing cars. Now, suppose the capitalist sees an increase in demand and wants to increase the scale of production, build another factory. The capitalist probably does not have all the money required to make that investment. So the capitalist borrows the money from a money capitalist. And the terms in which the borrowing happens is really a fixed term contract. So the capitalist with the money will give the money to the production capitalist, let's say for a 10-year period. And at the end of 10 years, the original sum of money will have to be returned. In addition, every year, a sum of money has to be paid to the money capitalist, that is interest. Now, if we think of the production capitalist who is doing the production, who is producing the car, from his or her perspective, getting that sum of money was useful because it helped to expand the production process. Now, the production process gives rise to cars which are sold, and then surplus value is produced and appropriated in the form of profit, and a part of that profit is handed over to the money capitalist as interest. So therefore, Marx makes this point that interest income is nothing but a fragment of the surplus value that a functioning capitalist has to give to money capitalist. And functioning capitalist means either industrial capitalist or a merchant capitalist who can either be involved in producing surplus value or in realizing surplus value. So now the total profit gets divided into two parts. One part is interest. Another part which remains with the functioning capitalist is what Marx calls profit of enterprise. So that is the part of the profit that remains with the producer of the car or with Walmart. Okay, so that's interest. Now, interest also gives rise to the concept of interest rate, because in the contract between the money capitalist and the functioning capitalist, there is interest rate, meaning amounts of money that the money capitalist will get for every rupee that has been loaned. So the total interest income divided by the total amount loaned is the interest rate. Now, how does the interest rate get determined? Why is it 4% and not 10%? So for Marx, there is no real economic theory behind the determination of the interest rate. He considers it as a process, as an outcome of the bargaining between the class of money capitalists and the class of functional capitalists. So the money capitalists will always want to have higher interest rate. The functioning capitalists will want to have a lower interest rate. The outcome of this bargaining process gives rise to the interest rate depending on their relative bargaining power. Now that relative bargaining power in turn is impacted by the amount of funds available in the economy relative to demand. So if there is a lot of funds available, then the bargaining power of the functioning capitalist is high and therefore the interest rate is low. And if the opposite happens, then the interest rate is high. So now if you look at different phases of the business cycle, so when economic activity is just starting from the a recession, there is a lot of funds available because there is not a lot of investment being made. So therefore, you can see at that point that the interest rates are low. And then if you come towards the peak of the business cycle, when a lot of economic activity is going on, a lot of investments are being made. So demand for funds relative to supply is higher and therefore interest rates are higher. So there is a very natural way to understand the fluctuations of interest rate. Now in interest rate determination, of course, in Marx's time, the role of the central bank was not probably all that important, but today it has become much more important because the central bank has tools available to impact the supply of funds through changing its own balance sheet. So the central bank now gets involved. So in a contemporary term, if we want to look at this determination, we will also have to think of the role of the central bank. Okay, now once we understand the notion of interest rate, then there is an additional concept of fictitious capital. So this is an interesting concept Marx discusses, and it is really a simple concept, though there is a lot of confusion about this in the literature. So think of the following. Say we are in a capitalist economy where the financial markets are working stably and there is a market interest rate. Now, once the market interest rate has been stabilized, all economic revenue streams can be converted into a monetary value today. So let's think of a revenue stream. Suppose there is a revenue stream which promises 100 rupees from every year from today for 10 years. Now we can ask the question, what is the monetary value of this stream of income for 10 years today? And there is a simple calculation which can, using the market interest rate, which can convert this stream of revenue payment into a price today. So this is known as the process of capitalization. So all assets which give rise to streams of revenue payment can be converted into a market price today using the average interest rate. And that gives rise to the concept of fictitious capital. So fictitious capital is assets which have these two characteristics. One, it gives rise to revenue streams, payments of revenue streams going into the future, which can therefore be converted into a market price today. Secondly, the money that is used to purchase those assets are not used in the circuit of capital. So that is why it behaves like capital in the sense that it gives a constant a rate of return to its owner, but it is fictitious in the sense that it is not involved in the production or realization of surplus value. So it is separate from that process. So let's look at some examples of fictitious capital. So one example Marx talks about a lot is government debt. So let's think of, let's say the US government or the Indian government. These governments need to borrow money from the market to finance their expenditures, because oftentimes their revenues which they earn from taxes are lower than their expenditures. So the way they do that is by floating bonds. So what is a bond? A bond is just a contract which is very much like a lending borrowing contract. Let's say we have a contract with the US government for $1,000. So I purchase the bond. That means I lend $1,000 to the US government. And the contract specifies what is the period of the contract, let's say 10 years. And then it also gives the interest rate, which it calls the coupon rate, let's say 5%. So what that means is I, who have purchased that bond, is now entitled to a revenue stream, which is 5% of $1,000, that is $200 for 10 years. And at the end of 10 years, I will get back my $1,000. So now you can see there is a revenue stream. I can capitalize it using the average interest rate, the market interest rate, and arrive at a price. So now what happens? There is a market where this bond is bought and sold. In that market, this price will be the price at which it will be bought and sold. Now, this is an example of fictitious capital. Why is that so? Because to me, when I purchase the bond, to me, the $1,000 that I have used to purchase the bond performs the function of a interest capital. So it is, to me, it generates a stream of payment just like interest income. So I get $200 every year. But the amount of money that the US government borrowed from me is not involved in the circuit of capital. It is not used to produce surplus value and generate and realize surplus value. So therefore, it is not directly involved in the production of surplus value or its realization. So the value of this bond is therefore fictitious from the perspective of the capital accumulation process. So that's one example. Let's take another example. Let's say shares of capitalist enterprises. So let's say there is Google. Google wants to expand, and to expand, it wants to borrow money. Now, the way Google will borrow money is slightly different from the way the government will borrow money. So what it will do is it will float shares, and those who buy those shares will become part owners of Google. So it's not a borrowing and lending relationship in the sense that we just looked at, it is rather ownership. Now, those who own shares of Google will be entitled to, again, annual or semi-annual or quarterly payment of dividend. So dividend is part of a surplus value that the firm will give to its owners. So now you can see that if I am owner of shares of Google, I get entitled to a stream of revenue payments, which is the dividend payments. So therefore, I can capitalize it today and give it a market price. Now, let's look at the firm itself. So the Google, the firm which does the production of whatever it produces, has some capital stock, it has buildings, it hires workers. So the capital stock that actually does the production, the valuation of that and the valuation of the stocks which are outstanding, which is really a claim on the surplus value that will be generated by that capital stock, is very different. So therefore, the total value of all the outstanding shares is another example of fictitious capital, because that is different from the value of the capital that is actually involved in the production and generation of surplus value. Now, there is one complication. The very first time that Google generates this money by floating equity, that money goes into creating capital. But once we have come after that step, then there exists a market where these shares are bought and sold, which is completely cut off from the actual production process. So when I'm talking about shares, I'm talking about the latter, not the first step. So again, you can see that is fictitious capital. And the third example of fictitious capital, which will take us to the next part of capital, is land. So now let's think of land. So somebody owns a piece of land, let's say in Ohio, and it's a big plot of land. That land can be used for producing corn, and that corn can be sold. So now what happens is the owner of the land, who is not the producer of corn, rents out the land for a period of time to a capitalist who produces corn on that land. And for that rent, for that contract between the two, the owner of the land gets a part of a payment. And that payment is what Marx calls rent. Now, we will come to rent in a minute, but let's think of the fictitious angle here. So for the owner of the land is entitled to a stream of revenue payments, which is the rent payment. So as long as the owner owns the plot of land and can rent it out, the owner will receive a rent payment year and after year. So again, given the market interest rate, we can capitalize it and get a market price for the piece of land. And that again is fictitious capital, because from the perspective of the owner of the land, the value of that land gives rise to a stream of revenue payments, just like interest income. But that money, which is used to purchase that land, is not directly involved in the process of generating surplus value. So therefore, it becomes, from the perspective of the owner of the land, an asset which is fictitious capital, because it generates revenue and is not directly involved in producing value and surplus value. So that completes the discussion on interest and related concepts. And so now we move to the final segment of capital, where Marx talks about rent. So rent is the part of surplus value which is appropriated by owners of land. So land should be broadly understood as any non-reproducible asset. So any asset which cannot be produced by labor, whose supply is fixed, which is given. Land is, of course, the primary example, but as capitalism develops, it goes to other things like water, forests, and other things. So anything which labor cannot produce, which is given to us by nature. People who, now in capitalism, everything is owned as private property. So these pieces of land, which is owned as private property, gives rise to an income stream to the owner. And that income stream is what Marx calls rent. Marx calls it ground rent. So now let us understand the principle via which this ground rent emerges. So an example that Marx gives is useful to understand this concept. So think of textile production. So textile production in, let's say, 19th century Britain. So textile production requires power. So anybody who operates, a capitalist who operates a textile firm, will require to make some payments to purchase power, which is used to run the looms and meet other machinery. Now think of some textile capitalists who are able to locate their factory just beside a waterfall. Now the waterfall generates power for which the capitalist does not have to make a payment. So those capitalists therefore have a cost advantage. So therefore they do not have to make the payment to purchase power. What does that mean? The going market price therefore generates an extra amount of profit for these capitalists. That extra amount of profit is what Marx calls surplus profit, which is over and above the average rate of profit that other capitalists get. And why do they get this? Because they have a cost advantage, because they are located close to a waterfall. Okay, now let's change nothing but ownership structure. Let's say now the capitalists do not own the waterfall, but there is a water lord. So there is a class of water lords who own all the waterfalls. So now what happens? There is a bargaining between capitalists and water lords. Capitalists know that if they can access the waterfall, they will get cost advantage. And water lords know this, and therefore they will give up access to the waterfall only if the capitalist can make a payment for the use of the waterfall for a given period of time. Now, how much will that payment be? Well, it will be exactly that surplus profit. So ground rent is just a transformation of surplus profit, meaning as the ownership structure change, a new class, a different class owns land or waterfalls or whatever, and they are able to bargain with capitalists because using the land confers some cost advantage to the capitalists and therefore generates surplus profit. And the landlord will withhold access to the land unless the capitalist is willing to give up all of that surplus profit. So therefore, the rent income that is earned by the landlord class is a part of the surplus value. And we can be more specific. It is the part of surplus value which can be understood as surplus profit, which comes because of the cost advantage of access to a plot of land. Now, if we think of different plots of land will have different fertility. It will be located closer or more further away from roads. So it has locational advantages. So all of these together give rise to a differentiation of rent across plots of land. Now, plots of land will also have different amounts of capital investment. Some will have more investment, some will have less. So once Marx has explained the total amount of rent, how it emerges, what is its principle, then he makes the case that this total rent can be divided into three parts. One part is differential rent of variety 1, which means this is the part of rent which you can associate with the fertility advantage or the locational advantage of a plot of land. Then another part can be associated with the differences in the capital investment across plots of land. And then there is a third component which Marx calls absolute rent, which is the part of rent which is not dependent on fertility differentials or on capital investment differentials. So now, in my opinion, this division is less important than understanding the principle of the overall amount of rent, because there is some controversy about differential and absolute rent. In fact, in my own research, I have come to the conclusion that actually absolute rent there is nothing called absolute rent. It will really be zero. If you allow capitalist farmers who use that plot of land to be profit maximizing, then they will invest on a plot of land as much capital as is needed. They will invest an amount of capital which will really mean absolute rent is zero. Now that's controversial. Many Marxists will not agree. But I think it is more important to understand the total rent and what is the principle behind it than get bogged down in the debates about the fractions. Okay, so let me summarize what we have studied so far. Volume 3 is about distribution of surplus value. The total surplus value gets divided into industrial profit, commercial profit, total, that goes to those who produce surplus value, those who realize surplus value. And then a part goes to money capitalists as interest. And then a part goes to owners of non-reproducible assets like land, which is rent. So this is the total surplus value. So at the end of volume 3, we really come to the conclusion that all the income streams of all the non-working classes are part of surplus value. So the exploitation of workers in the production process is the source of the income of everybody, even though it is difficult to look at it directly. So you can see the capitalist who's producing the car and you can see that he is exploiting the workers. But then through this complicated process, it is that surplus which finally percolates through society and emerges as the income of the investment banker and Walmart and every other capitalist firm, whether it is directly or indirectly involved in production. So that is really the argument, and I will stop here and I will be happy to take questions, comments.
Thank you so much for that, Professor Basu. So I had a couple of questions, but first let me open it up to the floor. Anyone, please just unmute yourself and go ahead.
I had a clarification about fictitious capital. So the fictitious capital would be for the person who is getting the shares. So in the shares example, if I'm buying the shares, the fictitious capital is for me or for the company that is giving the shares?
Well, fictitious capital is fictitious capital. It's not for you or for the company. It is, so the asset itself is the fictitious capital.
Okay.
The shares and the total amount of shares. Now for the company, it has its own capital stock. It has its machines and computers and factory. That is the real capital.
Yeah.
So Marx wanted to kind of juxtapose and contrast that capital which actually does the work of production from the market valuation of the stocks. And that's why he called that fictitious capital.
Anyone else?
Good evening, Professor Basu. Just I have a question further on continuing on the same fictitious capital. So basically, we are taking out the imaginary capitals, as the word says, like be it a share, or now we have moved to this currency trading, all these trading things which don't contribute in a production process, right? Just to have as an assumption way.
Right. So it is any asset whose ownership gives rise to income stream. So that is important. So things like just the trading itself is not important. The important part is that it is an asset, and if you own that asset, you are entitled to an income stream. But that amount of money which is used to purchase that asset is not directly involved in production. So yes, all these Bitcoin and these kinds of things will be part of fictitious capital. Yes.
Yeah, I just want to continue before Surit. So like organizational valuations, they do based on the current, whatever the traded prices, and also those kind of what they are projecting as a asset, as a organizations, whatever they call the value, which is not actually the value. The value is something which is the production value. The remaining thing is something like which is imagination, which just exists but doesn't actually which doesn't put any contributing other than in the production process, like based on the trading values, share values, they calculate and then say this much big company this is, but its own production process, that value doesn't contribute, right? The value differs there.
Yeah,
So
exactly. So the discrepancy is precisely important for fictitious capital. So share valuation, you can have various theories. So some organizational things or other things, and whatever those things are, because they're not directly the value itself of the capital stock involved in production, that discrepancy is important to highlight, that the valuation of the market is the fictitious.
thank you.
Sudeep?
Yeah, please go ahead.
He lowered his hand, so maybe he's got it.
No, sorry about that. Yeah, hi. Thank you so much, Professor, for giving us this lecture. I'm sure I speak for everyone when I say that we all really appreciate it. And my question actually had to do maybe a bit tangentially with fictitious capital, but perhaps perhaps you're familiar with Prabhat Patnaik's essay about the 2009 financial crisis, where he tries to discuss not only, one common issue which was raised, which was that a lot of these regulations were lowered, and for that reason, we had a economic downturn and a recession. And Professor Patnaik over there makes the point that these regulations were also in part what drove the growth over there. And I think, if I'm not wrong, that is an argument regarding fictitious capital. Like I guess it's more of a clarification. And I was curious if you agreed with his assessment of the financial crisis.
So, well, I mean, there are different institutional setups where trading fictitious capital or assets which behave like fictitious capital can be made more easy. Now, one thing that was important in the run-up to the financial crisis was that interest rates had been lowered for a very long time, and a lot of these trades in financial assets are not using the money of the person who is doing the trade, but rather borrowed money. And in that case, if interest rates are low, the incentive to use that money to do more speculative activity to make profits from that goes up. So that kind of argument certainly is important, because it helped the ballooning of asset prices and markets where these assets were traded. So in that sense, if that's the argument, I think that's correct, that these regulations which were removed and interest rate lowered and various kinds of things done to help in the trading of these assets were probably a contributing factor to the crisis. Now, one thing to keep in mind is, why were these regulations removed, and were they in a certain sense also functional to the period before the crisis? And one argument that is made here is that from the early 80s onwards, because the divergence between productivity and real wages start growing, the purchasing power of the majority of the population was not rising, and there was a kind of a chronic insufficiency of aggregate demand to purchase all these commodities. So in that context, one way to enhance purchasing power was to kind of engineer a stock market boom or a boom in housing prices, because those assets could then be used as collateral to borrow and spend. So there is a logic to why the interest rates were lower, because it was meant to address the insufficiency of aggregate demand by engineering an asset price boom. But yes, one unintended consequence of that was that the financial fragility of the system increased because the amount of outstanding debt kept increasing. And when there was a contraction in house prices, this whole edifice kind of fell down. So yeah, regulation did play a role there. So I have not read that article. So what I understood from you seems correct.
Is it all right if I ask a follow-up question, Aditi?
Yeah, sure.
And yes, okay. Thanks so much, Professor. So I was wondering, with the current situation that we're looking at, how do you assess the situation that we found ourselves in? Yet again, after 10 years, where we're looking at the possibility of maybe a worldwide recession happening, and what I'm trying to say is that maybe at that point there was a large role that was played by fictitious capital in 2009. But do you think that is also what is to blame in our current scenario, or do you think maybe the problems are a bit different today?
Yeah, I think the problems are a little different today. So we are certainly going to see a global recession in a year or 2 years. So there is no doubt on that. The reason for that, of course, is different. So right now, the economy, because of the pandemic, has seen a very strong supply shock. So it's really coming from the supply side. So global supply chains have been disrupted. That led to demand going above supply in large parts of the world, because production had become so globalized and the supply chains were so important in making the commodities available. So once there was this supply shock, the demand, even though demand was not rising at that point, even then demand was far ahead of supply, and that created the original push for inflation. On top of that, of course, some governments in some countries tried to at least put a floor to the demand by putting stimulus. So demand did not fall as much if those stimulus were not there. So therefore, there was overall a kind of structural discrepancy between demand and supply, primarily driven by the supply shock. Then there was the oil price shock because of invasion of Ukraine. And since oil is something so important in the contemporary economy, when its price rose, that fed onto the original inflationary pressure and led to inflation. So we have seen inflation rising across much of the developed world, and the central banks will now certainly react. And so the central banks will raise interest rate to try to reduce the discrepancy between supply and demand, because that is a tool they have. I mean, they do not, no matter how powerful a government, no government in the world has the capacity to repair the breaks in the supply chain in the global economy in a short period of time. So they will use the tools they have available, and interest rates will be the way. They will raise interest rates. Oil price will probably not fall for at least a year or so. It might continue. So oil price rise is a kind of negative supply shock. Interest rate rise is another shock to costs, because of which purchasing power will fall. And so we are certainly headed to a recession. But in this setup, the role of financial or finance or fictitious capital is much less than in the run-up to the 2008 recession.
Thank you so much, Professor.
Does anyone else have a question? Okay, so Professor, I also had a question, and it relates to, rather it applies to how we actually apply these categories of merchant capital and rent. So I worked to some extent on the digital economy, and there's this growing debate on what to characterize these large platforms and or the aggregators as, right? So Amazon, and one way is, like you earlier mentioned, merchant capital. At least certainly early Amazon was just precisely that, for books and whatever. But for another way to, some people are viewing some of these is basically they are drawing a rent from their hegemonic market control over their platform being a site for accessing a lot of services. Uber, so say from to Zomato, the whole gamut of these things. And so my question was, firstly, how do you see, are these more, is this more rent capital, or is this just merchant capital in a digital form?
Yeah, this is an interesting debate that has been going on. My own understanding is that it is better not to characterize these incomes as rent. At least I don't see a parallel to the concept of rent as used by Marx. And the reason is the following. So in rent, you need to have a non-reproducible asset. And ownership of that asset gives rise to an income stream, appropriation of part of the surplus value, and that is what we call rent. Now, in the context of these digital platforms, what I see is rather that let's talk of this aggregator. So what the aggregator does is really, it creates a monopoly position because of network externalities. So once you create a forum or a platform which many people use, then the additional cost of using that is so low for new people that other competitors will not come. Indeed. Now, this monopoly power will give rise to super profits. Those super profits are not rent. I mean, they are super profit coming from the monopoly position because of certain technological characteristics of whatever they are doing. So I would not consider those as rent. But I see that a lot of people use this term rent when they talk about Google, and they want to say Facebook's income is all rent. There is also, so this notion is also used in the pharmaceutical industry. So because the cost of production is much lower than the price, the extra amount they want to call as rent. I mean, again, there is, I don't think that's correct. I mean, it's true that they charge much more, but the argument and the logic and the mechanism is not that they have access to a non-reproducible asset. In fact, they have produced that something, because it involves a huge amount of fixed cost, which is hidden from view. They cannot sell it at, so an open market system cannot allow the production of knowledge goods or pharmaceutical industries other than by the creation of monopolies, because there is no other way to recover the huge fixed cost of production. So it is a problem of the free market system. It is not rent. So if this production of knowledges were being organized by a non-market principle, then you would have no problem, because then all this recovery of cost would be transparent and a government system could deal with it. So I see the problem, but I don't want to use the concept of rent because there is a specific reason we use the concept, and let's stick to that.
Okay, so just a quick follow-up to this. So in general, then, Professor, for you, IP revenues are not rent. They are then, in a certain sense, the same sort of procedure where you are trying to, they are arise from the nature of recovering that fixed R&D cost. But IP for you then is not rent in that sense.
Right. I think, yeah, the revenue that comes from intellectual property ownership is I want to treat it differently because it is something which has been produced. It is not like land. And yeah, again, I mean, there is, I think, controversy. Some people want to treat it as rent, but I think it is better not to treat it because we should define our concepts and stick to them and not like give up the conceptual clarity which comes from using concepts in a particular way. So
Absolutely.
Yeah.
Absolutely. So I guess then again, this is a quick, small clarificatory question. So land in that sense mostly refers to non-reproducible natural assets, basically, because presumably then anything non-natural is in that sense produced. Okay.
Right.
So my other question is then slightly more open, and feel free to answer it to whatever extent. Another thing, I'm sure you know, a lot of these companies aren't actually profitable. They are alive in a certain sense only because obviously they have a certain monopoly position, but they are dependent on this heavy blood transfusion of VC money. And the question is that, you know, during the pandemic, we saw a huge rise in their valuation, and of course they did a lot of money. And I believe the larger tech groups companies still are certainly, you know, they have these huge cash reserves that they sit on. But I think we're seeing now there's a certain fall, at least in the stock markets, there's a downturn. How does this eventually play out? Because if Uber says in its IPO, we're not profitable in the medium term, and yet people keep piling on money into it. Or, for example, so I was working on digital agriculture here, and someone was talking to a small agri-tech startup, and he explained their production process to them, and he said, but you're not profitable, how are you going to make your return? And he said, you know, it's simple, we'll just collect data for a couple of years, then we'll sell it to some bigger firm, but that VC money will keep us alive. I'm just curious how, and since private equity is growing in sort of in share and you know, ownership of a lot of or at least whatever share of ownership in a lot of companies, how does this play out? Does it sort of how long does this sustain itself for this whatever very particular phenomenon?
Yeah, this is quite,
I mean, it's very open. I'm so sorry. It's just yeah.
I had actually one related question. So then what is keeping it going? So like, where is the money coming from in this? Is it coming from another composition, another sector which is actually has some production and has money generation profits, or how is that it's getting distributed to this, or how is that coming from?
So if I may also then frame an answer as a question for Professor to then clarify. To me, the way I see where the money comes from, at least, is from the falling rate of profit, where there's a lack of profitability elsewhere. And here, at least, there's some belief that going down the line, these monopoly positions will pay off. That's the way I read it. But yeah, sorry. Now I'll keep quiet.
Yeah, this is a interesting and complicated question. So, I mean, there are a couple of things that come to mind. I have not really done any research on this, so these are just kind of off the top of my head, whatever comes. So one thing, all these big firms, what is very interesting is that let's say Facebook or Google, it wants to develop, let's say, some aspect. Now, but it does not want to do the R&D. So a very nice way for the system to work out would be if there was a startup which is funded by some VC money, which develops let's say it develops a new AI model, test it for 10 years, it is sustained by VC money, and then Facebook purchases it, incorporates it into its system, and that is very beneficial to Facebook. Now, what about the VC? Now, the VCs are really, I mean, a lot of them are wealthy investors who have made money elsewhere, and they are using their money to kind of, it's a casino, they're betting. So just like there is a casino, real casino, there is a casino going on here, and they make bets. So some of their bets fail, some of their bets work out. On average, I think, as long as on average the bets kind of give a positive rate of return, you will keep seeing money coming in. Then there will be, I mean, there is the whole ideology, this startups are doing radical things. So there will be a lot of engineers coming out of Stanford, Harvard who will get attracted. It will be very beneficial for these big firms like Google. So I think it's a kind of whole ecosystem where it is probably difficult to trace where all the money comes from. But if we look at some of the big venture capitalists, they were all involved in some activities which generated money previously, and now they have pots of money. So you can think of them as those money capitalists that Marx was talking about, but they're not giving loans, they're making bets. So they're using their money to make bets, and their bet is that, so they make bets on 10 companies, 9 of them fail, one is okay and does well. It is bought by Google for, let's say, 2 billion, and that makes money for them. So on average, when they average it out of their 10 bets, probably it is giving them a positive rate of return. So that's why they are kind of continuing. So I kind of see it in this way, that it is a system which is kind of beneficial for the big companies. So I have some friends who are into this. So they have set up small firms. There are 5-6 people who are working to the ground, developing technology which is kind of cutting edge. And in 10 years, they will be bought up by some company. But if they fail, they fail. And they have money from various venture capitalists. So I see it in this way. I mean, probably there are other angles and aspects to think about, but these two things kind of come to my mind. It's an aspect of betting, and it's an aspect of passing on the cost of R&D onto this very precarious kind of setup, and then supporting it with ideology that this is great work and you are the new Google and this, that, and so that will attract very sharp and bright minds. So, and that kind of keeps it going.
So I think Professor is very helpful precisely because I think someone who's not dug as deeply into this comes at it, but has obviously a very solid theoretical background, actually offers good insight into the problem. I think I've learned a lot from your answer. So I will ask one just quick follow-up question, then we can see if anyone has a question or we can end. So just to take your own example then, and assuming that there is a certain crisis of rate of profit, that we're seeing an increasing amount of VC money going into these firms. To take your Facebook example, if the firm dies out, then that VC takes on that money. But like you said, let's assume on average, they get a profit. They do make a profit. They make a profit because, like I said, they sell that. So they're investing their money into the startup. The startup is loss making, or say or like we're assuming profit making. They sell it to Facebook. Now, Facebook gets its R&D advantage from there, but presumably it is still, that loss is still then ultimately going on to Facebook's books, so to speak. So my point then is, at some point it will, should this process continue, and I agree, if you see actually their cash balances, they get used up only for these things. They just acquire a new thing, or some new AI vision firm has come up, but at some point surely, or another prima facie, at some point this would then start to bite seriously, that okay, they would have to look at, okay, this is now becoming a bit of an issue, especially because these firms have also stopped doing R&D themselves, because they have a monopoly position, like you said, they can just buy people.
Yeah, so I think there is some unsustainability built into it, but there are some aspects which are really more troubling. So one thing that I have kind of been following recently is the whole development of AI, and you know, the better AI is those which have access to larger data sets. And so what is emerging gradually is there will be a few firms which have access to enormous data sets,
Correct,
which can be used to train the best AI, and they will really it will just be a size advantage, which will allow them to sustain themselves in this emerging scenario. So if you follow these new AIs and the amount of computing that they require, and the new models, the amount of parameters that they have, I mean, it is now beyond even the biggest universities. So it is completely gone to these big 4 or 5 firms.
correct.
And if this technology becomes the dominant way to do many other things, then their advantage is so high. I mean, it will be difficult to actually check their power in a way that regulation can also do. So they will be beyond that. So that is really very, very worrisome. And true, there is some aspect of unsustainability, but I think this system really kind of works for them, that they don't pay for the R&D and they don't take the risk. They just take the winner. So 10 of them do the thing. So they are not taking the risk.
Okay, yeah, okay.
The
Cool.
VC is taking the risk, or it is probably some university which is funding the professor who is part-time doing the research in the startup. So it is some other source of money which is taking the risk, and then whoever wins, they just buy it out. So for them, it is working out, and the amount of size that they have managed to generate for themselves, it's really a very big monopoly position is certainly going to emerge.
No, so I think, Professor, I think there are, like, now governments are taking step towards, there's some data sharing policies. For example, I think India thought of someone, and more importantly, EU is coming up with these policies, because like you said, absolutely, your basic raw material there is data sets, and you are then just gaining absolute control over these data sets, which, like you said, will result in massive market sort of advantage. Okay, I'll stop on that tangent there. Hopefully we'll discuss this sometime later. Does anyone else have any final questions? Okay, thank you so much, Professor Basu. This was tremendously informative. Both your answers and I think your explanation of the parts 4 to 7. I know certainly I've made some notes. We will keep these in mind when we read, and it'll be very helpful to go through, especially Engels editing with these concepts in mind. Thank you so much, Professor. Hopefully we'll have you back sometime soon.
Okay, thank you very much, and all the best for your study group. I wish you all the best.
Thank you, Professor. Thanks a lot. Bye.
Bye.
Okay, we can stop recording.
Yeah.